So I'd like to welcome Harp Gahunia to the CFO Hive podcast, episode number 2. Harp's a phenomenal CFO that I've had the pleasure of working with and getting to know over the past couple of years, from private to public companies, startup to scale up, really across technology from AI to crypto. Harp's seen it all, done a lot, and really pleased to have him here. Harp, thanks for being here. How's it going?
Not too bad, David, and thanks for having me on this episode.
My pleasure. So yeah, what are some of the areas or industries within technology or even beyond that you've been focused on?
Being a fractional CFO, you end up picking up a lot of skill sets along the way. You end up seeing a lot of different models. I think what's really excited me is sort of emerging technologies. So payments being one of them. Telco back in the day. And now sort of even AI is sort of the next big thing that everybody's looking into, and how that sort of works into existing businesses is interesting from a technology perspective. But even AI companies themselves and how they're changing the landscape seems to be sort of the big thing right now. Crypto is another one that I've been looking at a fair bit and have been a part of. Which is a natural extension of payments, interestingly, but just not a lot of payments people that are going over to that space. While there's other ones as well, like healthcare, again, something that AI is playing heavily into, prop tech, legal tech, all of that kind of stuff. I think that's sort of the next wave that we're probably going to see once sort of investment and money starts to come back into the market. I think that's where you're going to start to see the big players also start to enter the space.
How'd you get into this world? How'd you get into this crypto, AI, tech, venture, high risk, high return environment?
Yeah, it's interesting. I was sort of looking for a way to work with startups, and I realized that there's a need there. Startups can't afford seasoned or experienced CFOs, and they need them the most because they only have their shares and their cash as their resource or their way of funding what they're trying to do. And when they have cash, there's so many things that they're trying to do all at once. And so a CFO coming in to sort of help them navigate through the different options that they have is something I think they need. And it's demonstrated through the success rate of startups. 1 in 20 or 1 in 30 actually succeed. Well, part of that reason is because there's probably not a seasoned finance person that's helping them navigate through the different options that they have. So I fell into that and started essentially biz deving myself at the beginning. I started with my grocery money client that I always sort of say to others, which is your 3-day-a-week client. If I can get that, it sort of gives me my foundation and lowers my risk. Accountants are by default try to be a bit conservative from a risk perspective, and this was my way of sort of lowering the risk, and that leaves me with a couple of days afterwards to be able to work with startups or whatnot. So it gives me a nice balance to not only see sort of new models, participate in emerging technologies, because emerging technologies, until the world of finance catches up to them and sort of says, oh, this may be an opportunity, there are entrepreneurs that are out there trying to create an industry without money, right? And just little bits of money or interest from investors, small investors that are willing to come in to sort of start that. Going back a few years, there weren't a lot of professionals that want to sort of go into the crypto space. Banking and payments, it pays well. So why would you risk yourself and your reputation to go in there? I kind of see it in a different way. You can help to shape what the industry looks like, which is a lot of fun.
Yeah, you talked about being risk averse, but then at the same time, it takes a bit of a risk tolerance to get involved with some of those companies.
Yeah.
When do those companies engage a CFO like yourself? Or is it at ideation? Are these sort of pre-seed? I imagine needs are going to evolve as they go from seed stage to raise a Series A, all the way to whatever exit, and you've been part of that entire life cycle. But what are some of the differences? Like, when do they engage you, and what do they look like in terms of what you could do for them at those various stages?
My view is that at any stage, I think a finance person or a seasoned finance person can help, but they can. And I say finance, I don't say CFO. And the reason why I say that is because you can play different roles as you come through. So two people with an idea, I may be in too early. But maybe there's a way for me to sort of figure out a way to help them via some equity and help them sort of grow and give them some advice, even if it's to direct them until the point that they're ready to hire a finance person. And when they're ready to hire that, maybe there's a way for us to work with an outsourced finance group, so that they're not hiring full-time staff. And then that sort of grows because there's a point at which the math just works to hire someone full-time. And as you're sort of building that up, then you sort of say, okay, why don't I come into an advisory role? Okay, now why don't I come into an interim CFO role? And like it's never always that order, but there's just different roles that you can play, and I think always sort of interviewing the people, whether it be the entrepreneurs or the team, to figure out what their needs are first makes a lot of sense. I always sort of try and sell a try before you buy, which we've done before as well, David, together. And that really is to sort of say, um, let me do an assessment of the company. At the same time, let me add some value. And really, the assessment, I try to push it to like a 30-day period. Give me everything you have. I'm almost like doing a due diligence on the company. Management team, presentations, board meetings, interviews with the top C levels, and what their vision is, their strategy, put that all together and sort of say, okay, what does the finance team need to look like? Through that structure, I think they get to see what I can do and what I cannot do. And then also see if I'm the right fit for not just the management and the leadership style, but also for what the company's needs are.
Yeah, no, I'm a believer in the model. I think a lot of folks, a lot of CEOs don't know what they don't know. And there's a lot of confusion around what a CFO can bring. And it's not the same as what you're talking about when it comes to the outsourced finance function. The CFO can help you establish what's needed and the right partners and parties to do that. But talk a little bit about some of the not so obvious things that you're helping those companies with. And I'm assuming there's a range from, establishing product market fit, what are their what's their cap structure, what milestones are they looking to hit before their next raise, understanding debt versus equity dilution. So yeah, dive into a little bit more of those areas of value you bring beyond the, get the finance function in place.
Yeah, it's funny. Like I find that founders have different concerns each and every time, and you're kind of trying to help them through that. Dilution of equity is always a big one. That's where capital markets sort of experience starts to come in. Balancing between debt and equity, trying to figure out what the right structure is, what types of investors, when do VCs come in, when do individual high net worth investors come in, when do PE companies come in, what is the way to grow the business as well, working in what is the right timing of M&A. Are we building a product or a business because maybe we're going to be selling? Should we be looking for a strategic partner, a strategic investor, or not, because there's other players that are interested? And I don't mean to overwhelm them when I sort of say, here are all the different things to consider. It's more to sort of say, you need to keep running your business. And why don't you let me handle this? And let's work together. One thing I say to every founder is, you're going to be pretty much married to your shareholders for a very, very long time. And so you just need to be very comfortable. Don't just follow the money. That's one thing. Valuation is another thing that always comes up. And I have been through storylines where if you make the valuation too high, your future raises become much more difficult. And so it's playing the long game and sort of understanding that, hey, sure, sometimes you're going to sort of say, we just need this one raise and we're going to be at break even by this, and we'll never need a raise again. The truth is that never happens. If you followed that and it did happen, there are probably other options that could have allowed you to grow even at a faster rate. The better way to sort of look at it is, what is that end goal, and likely what are sort of the strategies of raising and growing along the way. Let's set a plan and iterate. Every year we're going to iterate, right? To see what that should look like.
The tendency is to raise as much as possible from the cheapest source of capital at that point in time. And I think that's a risky proposition because of what you talked about, which is strategic money versus dumb money. And that could make or break your business depending on what you're doing, what market you're playing in. But taking investor capital that comes along with connections, understanding of the market, and those relationships that can really unlock value. And being in the boardroom, you're going to be married to them, as you said. So are they aligned with your long-term vision? Are they going to challenge you in the right way? Are they going to educate you on things that you don't know? And if they're simply a paycheck, well, sometimes that's okay too, but you need to know the difference. So, how much do you need to get to the next milestone where your valuation is going to be a lot higher and the dilution is going to be a lot lower? So how do you balance that? It's not so easy, but it needs to be considered.
What a CFO can also do is help out on the other support functions, which is legal and HR. Accountants finance people deal with lawyers all the time. There's two parts to a legal document. There's the legality, and then there's the business terms. And the CFO forms a nice bridge between what the entrepreneurs are trying to do and the deal terms and the deal and the legal document. That's one piece. And then the second piece is HR. You'll find almost every business, 60 to 70% or even 80% of the costs of a business are people costs. And so why would the CFO not be leading that charge alongside an HR person? You need to sort of have those sort of functions so that a CFO has sort of understanding and control over the costs, over the future agreements. There are so many times I've walked into companies where I'm like, okay, we need to work through this agreement that was just signed because here are the future implications of it. And they're just tweaks. They're things that got buried in there, right? That the lawyers were like, we handle the legalities. If that's what you want, this is what we put in. But they never really sort of looked at the implications of that. And look, I'm not blaming entrepreneurs and stuff like that. It's hard to appreciate the pressure that they're in when they just came up with a new idea and they're ready to sign a deal with a Google or a Microsoft or something, and they're like, sure, just sign it, just whatever it is, just sign it. And you're like, sure, but some of these things you probably could have negotiated and they still would have signed it anyways. Or it would have been good to test them on it because this is how we're going to get stuck now. And so that's why, as part of that due diligence period, I always do check their major agreements, right? And their major customers and stuff like that.
Yeah, I've been there, and I have, as you said, that's a business decision. I remember lawyers all the time on those discussions. I mean, they'll outline the risks, but they're not going to provide the business advice. And so that really falls on the CFO. And then a little bit of a tendency of CEOs, and it's understandable, especially in early stage companies, is not thinking about the repercussions of those commitments down the road. And you see a lot of agreements when things don't go as planned. Day one, everyone's expecting everything to be great, but when things go a little bit sour, people go back to those agreements and they think, how did I get myself into this?
Yeah, and look, sometimes also when we're signing agreements, there's something in there where we'll identify and we're like, look, this is going to come up in the future. We have an awareness of it. So going into the signing, we have to decide whether we're willing to accept this because this is going to happen down the road. And that is much better, David, like you're sort of saying, than later on down the road, like, why did we sign this? It's more like, okay, time has come, right? We said this was going to happen and it's happening. We understood it, but it was worth it for us at that time. We made the decision we did and we were willing to live with it. And now we're paying our price.
Because, if risk is a percentage of a deal, I mean, if the company goes to zero, the risk is zero. So ultimately, you have to do what you have to do to move business forward. HR is another big one. And I feel, as you mentioned, that it's probably also underappreciated the extent to which a CFO plays a role
Mm-hmm.
when you're setting up for the first time hiring a sales force. We had done that when I was CFO, and we were launching, not launching, establishing a U.S. based sales team. You're setting up benefits for the first time. You're setting up compensation plans, and everything you do is going to magnify them as you scale up. It's hard to start
Yeah.
something and then take it back. And so a CFO could really look at what does that mean and be really thoughtful. And then when you dive into incentive plans, that's where the real art comes in, where the value of a CFO to understand what are the economics of this business, the timing of cash collection and sales, and factoring that all into how to motivate reps to build alignment. And so you really want your top reps who are going to hit home runs for you to take home a home run
Yeah.
with a paycheck. And how do you make sure that that's aligned with the success of the business? And that's again, I think a little bit more art than science, but certainly a place where CFOs provide tremendous value.
Yeah, and also an allocation of resources. So, kind of taking a quick step back and then coming back into it. What I've kind of found is in my interview process at the beginning, I always check to see what the educational background is of the entrepreneur. Meaning, because the way that they build the company is very conducive to what their background is. A marketing based CEO will most likely allocate more budget to marketing. A tech-based, a CTO-based CEO might end up putting more money into development. And so right-sizing the different departments, R&D, G&A, sales and marketing, is another task that I've had to do a few times as well, where I'm like, oh, did you guys know you're putting 40% of your money into R&D? Is that right or wrong? I don't know if that's right. Seems a little high to me. And also, looked at the comparables, right? Here's some public company comparables. This is how they're allocating. You're a little higher on here, a little lower on here. It could be right or wrong. Tell me why, right? Is R&D higher because you're working on a new thing that's just going to blow this away? Are you doing that because you're catching up? Do you know that it's at the expense of that? So that is quite important. You kind of you start to coach the C levels on a pod based approach. So it's kind of like, what's the capacity of here? Where's the capacity of here? Where's our bottlenecks? Okay, we need to increase our capacity here. Just dumb it down for me. If you can dumb it down to me into a pod-based approach, then I know that you've simplified your department in a way that I can understand it and I can model it. And we can work together that way because that C level is the pro at that particular department, and I've forced them to simplify it for me, which then overall, if I do that with all of the departments, the engine I think can run in a much more simple fashion and not be as complicated.
Yeah, so you get a good sense of fixed versus variable costs
Yeah.
in the structure. How things scale over time when you hire X number of sales reps.
Yeah.
At some point, how many support staff do you need to hire?
Yeah. Do you hire a vendor? Do you outsource or do
Yeah.
you hire internally? Right. Like that alone is a lot of one-on-one conversations with the C levels.
We talked about money, capital, and I feel like that's probably the number one reason folks think they need a CFO, and it's probably the right reason. Walk me through a little bit of the anatomy of a cap raise, and you can keep it generic, but the normal course is probably an equity raise, earlier stage company. What are the things that have to be in place, and how do you kind of walk through from the time they engage you to closing on such a deal?
I think the starting point is to actually have a business plan together
Mhm.
that works, that makes sense, that everybody is behind, and demonstrating some success that the business plan is working. The second piece is to really understand the stage of the company that you're at. Are you a startup? Are you pre-revenue? Are you breaking even? Are you at the growth stage? Each of those stages have different types of investors. The industry you're in have different types of investors. And so I'll look at comparable companies, review their sites, whatever presentations that they may have, investor presentations, and really understand what are the stories that they're telling. Because they are sort of the public entities that represent sort of that particular industry, and what is common in there, and where are they differentiating, and where does our business plan fit in relation to that. That gives you a pretty nice story of where you could say, okay, this is where we think the story should go. And then you start to interview bankers to see who would be the right fit. When you're looking for a banker, you're looking for one that has maybe raised in that environment or in that industry, and also is very interested in doing the raise for you. You got to put that business plan together. You got to sort of figure out what that pro forma cap table will look like. Okay, this is what it is now. Under this structure, this is what it's going to look like. Here are the sort of the different ways that we might be able to play with it. Maybe we want a portion of this as debt. Maybe we want to position it as convertible debt right now. Maybe we want to do a different class of shares, which by the way, as a side note, I'm not fond of. Advice that I've received from past board members that have been very successful is try and keep the cap table as simple as possible. And I've had many examples where that has not been, and also try to treat every shareholder equally the same. The larger shareholders always try to want extra rights. That's why they ask for preferred shares or a different class of shares. And trying to keep everybody equal is usually the best way to go. Otherwise, they start, there could be additional influences that they put in that might hamper the company and its ability to sort of do what's best for everybody. And so you have to sort of get the presentation ready, get the banker signed up. If you think other bankers should be involved, which is a great way for future raises, you end up sending up a syndicate with a lead banker that you choose. And this is all sort of pre-planning for future raises. And then basically you go out and do the raise, and you put together a data room, which has all of the information in there. You sort of anticipate, with due diligence, prior to due diligence checklist, what they might want, set it up really nicely, like you would, audit papers where it's all sectioned off and stuff like that. So it looks nice and pretty with the presentation in there. And then the banker is, you basically go and do presentations to the banker and to their group of people that are going to sell the idea. And then they go out there and sell, and you end up doing a bit of a road trip. They try and put all your interviews. It's like selling a house. They'll put all of the people that want to see your house, or all the people that want to know about the company. They sort of lock them into, like a 2 or 3 week road show that you go out and do. Go and present to everybody, and then figure out what the indications of interest are, and you set a close date. You sort of say, hey, look, it's not going to be open forever. You sort of keep that float, the amount that you're going to raise, to what you need, in a reasonable amount. And by the way, like I don't recommend raising a ton right at the start. The reason why is because the dilution is usually pretty high. When you're building your business plan, you're going to have phases, or you're going to have sort of like, here are the goals and the targets that we sort of need to hit. And I think you raise up to that point and then some, a buffer, and not anything more, because when you raise to that milestone and you deliver on the milestone, your valuation increases. And then when you raise again, your dilution is less. And you keep doing that as you go along. Make sure that you have a really good reason to raise, a very compelling reason to raise. Sometimes it's, look, if we make this acquisition, here are the synergies, blah, blah. And, here we have an LOI signed with this company. It's non-binding. It's subject to financing. If we do this, this is what the company becomes when it's combined. That's a perfect example of kind of giving them a really good reason and having all of that work done ahead of time, as opposed to, hey, we want to look for an acquisition. Can you give us some money? And then we'll go look for one. That doesn't work so well. And I've seen that. I've actually seen that in the past. And that could be also, hey, we want to build this new product. That's very different than, we've built an MVP of this product and we have a customer that's interested in the product, and we have an LOI with the customer. So there's always little things you can do without spending too much money to make the story stronger for why you're raising. And so that's another reason to sort of work with the entrepreneurs for that. So lots of sort of things. You have a legal team that helps you sort of put together the transaction and facilitate the transaction so that everything's done. You need to put a shareholder agreement together. You need to update the cap table. You probably need to upgrade your software for capital management. And so there's a lot of sort of steps that are involved, and it sort of all happens at the same time.
I'm thinking about my FP&A and my love for financial models, getting into Excel. I do remember in venture, I would build pretty sophisticated models, and investors would tend not to look under the hood too much. It might have just been early stage enough that it really was about the story. But I was always making sure everything tied back to the story in a way, down to the Excel model. But what I also did was I had multiple versions. And this is maybe back to the sort of contingency planning. There's an optimistic version, there's sort of the base case, and then there's the pessimistic, just in case type of version. What's your approach with that? Are you going out with your most optimistic and sort of budgeting for the most pessimistic? How do you balance those scenarios?
Yeah, it's funny because I find when I walk into an existing company, founders are used to a certain way and they have an understanding of a certain way. And I take a different approach to this. I sort of always advise that, look, only build a model that reflects the valuation, provided you can deliver to that. So you build your realistic model and you sort of say, what is the valuation that we're going for? And if it's too high, I scale it back because it gives me the chance to underpromise and overdeliver. It's a model that reflects the valuation that we're going for. We're gonna kill it. Arriving at the numbers and stuff like that, you work with the whole team. You sort of say, okay, let's take a top down, bottom up, and a top down approach and see where we land. And now let's sort of say, okay, what are we really willing to accept as a dilution and as for valuation if we're going to go off for a raise and for this much of a raise. When you sort of exceed that and hit the milestones and exceed that, your subsequent raise is so much easier. And you didn't underpromise, overpromise. You just sort of said, this is kind of what the valuation is. This is the model that we're going with. If you believe that we can hit this, then let's have you invest. Now, in terms of the most pessimistic, I like to manage that more internally by way of cash flows, because if I'm going pessimistic, cash is king. Cash is all that matters. I don't care about accruals and stuff like that. I care about where that's going to be. The optimistic scenario, you can always build that into your deck, right? You can sort of say, this model does not include this, and this LOI we signed with Microsoft, this deal that we signed, us switching over to this vendor, which is going to reduce our cost by 50%, doesn't include all of that. And it's great to sort of let investors sort of say, okay, there's still even more. There's still more to come. And so I try to fall within a window of raises. I find in your initial raises, you dilute the most. That's the hardest thing to work out with the entrepreneur. Typically I see 20 to 30% dilutions, and I'm like, you ready for this? Because it's going to be less as you go along, and that's why I don't want you to raise so much. But we need this much cash, and the math starts to work out itself. Keep in mind as well, entrepreneurs will always say, I have the best idea since sliced bread. They may be, but I think what they just have to realize is that the investors on the other side are sitting with a stack of presentations that are this high, and you're going to get added to that presentation. And all of those presentations, every entrepreneur is saying, I have the best idea since sliced bread. So it doesn't differentiate you. The way that you sort of play the game there is you need to anticipate, what are the valuations in there? What's the model that they're giving with those valuations? And how do I get myself to the top of the deck? And if you go out with outrageous valuations, or really low models, it has to be a nice balance. Then you're throwing yourself out of the deck. That's really what it comes down to. It's that game of trying to get the most amount of interviews. Then the entrepreneur has the ability to sell. And that's where they shine. That's why they're entrepreneurs.
Yeah, you talked about real estate before. It kind of is like putting your house up for sale. If you price it too high, no one's going to show up. You
Yeah.
kind of want to build a little bit of bidding war, FOMO, and excitement around what you're selling.
Yeah, and just like those nosy neighbors that are looking to come and look at your property, there are going to be people that are looking at your company that are just fishing, right? So they want to hear more about the idea. They have a chance to maybe look at the data room. By the way, I would also recommend that you set up two parts to the data room. One is sort of things that you're willing to share, and then a second piece when there's some sort of a document like an LOI or an expression of interest that you unlock. So you always have to be sort of careful. There's also people who are always trying to get exclusivity. There are also companies that come in with really high bids and then later negotiate you down after they've gotten an exclusivity with you. So there's little games. Savvy investors, they know how to play those games. And truth be told, I've been stuck in those situations before as well. But that's where the experience comes in, because it won't happen again a second time.
There are a range of sources of financing. We talked just broadly about sort of debt equity. You talked about the VC versus the private equity versus the angel investor. What are some of the sources of financing that you advise CEOs to consider, particularly in tech, where you've got shred credit and sort of financing that may be coming from venture debt type of players, all the way to the traditional banks, and then obviously the VCs and the equity investors. So what are the various sources of capital?
Yeah, that's almost like almost needs a masterclass on its own, because there's so many different ways to navigate. But I think based on the stage that you're at, it definitely, there's different players that come in and out. But there's also creative ways to get funding. So one is government funds and grants and stuff like that. In emerging industries, there's always money around and available. Two is there are always strategic investors. There's family offices. Later stages, there's VCs and also private equity groups. And sometimes bankers will help you look for that versus not, depending on what stage you're at. Seed capitalists, angel investors that are sort of more at the earlier stage. There's friends and family. Don't ever forget that. If you believe in the idea, if they believe in the idea enough and they're willing to put a little bit of initial capital, sometimes later investors do look at that as well. They sort of say, how much skin in the game do you have? And reputation skin in the game, because you got others to come in as well. There's your standard friends and family, you raise at a certain valuation. And by the way, structurally, you can, what's becoming more common is safe notes, where look, I need this much money, but if I ask for this much money, I'm giving up 100% of the company. And so why don't we set this at a later valuation? So that works quite well at the beginning stages. And depending on how much you grow, you go for additional angel investors. Then you move into sort of your first real round, which maybe you get a banker involved, and then or VCs. You go both routes, and you sort of see which deal sort of works out the best for you. And then later on, you do your series A, B, C, D, which really doesn't matter what that is. Really, all that really means is what is the next stage that you're going to hit, where you're going to be doing a bigger raise, because you're about to tackle something much larger. Yeah. The letters, it doesn't matter to me as much. Some people get really behind that, and I'm like, I don't know. Name it whatever letter you want.
Whatever you want to call it.
Yeah, this is the number that I need.
Right.
This is the value. This is the amount of money that I need to do this for my investors. Do you want to become an investor?
Right. What's different today than 5-6 years ago when companies were going out to raise capital?
Yeah, look, during the pandemic, money and capital was readily available. It's bubbles, right? Like, and I think a lot of finance people talk about these bubbles that form. People get there's a new industry that's forming. it needs time to grow and incubate. As it starts to grow, investors start to come in, and it gets more interesting. And then there's more investors that come in, and then the big boys start to come in, and they invest huge amounts of money. And then it gets to a point where there's people who got investors that got left behind, and they're like, now we're going to put into money, but there's not as many good ideas. So then crappy businesses and ideas come in and say, hey, we know there's money in this space. Let's start looking for money because we know that there's some people trying to catch up. And then the bubble fails because all of a sudden some of those crappy companies that even some of the large investors got into start to fail, and then the bubble bursts, and then it comes back to reality. We're probably going to see that with AI, right? And it's funny, when you're at the beginning stages of the bubble, you're like, never. AI will always, but we've seen it with payments, we've seen it with other industries as well, and we will continue to see it in every place because of the bad that comes in as part of that. What I'm finding different now is, when that pandemic hangover happened and sort of the markets went down, all investors started to hold their cash. Interest rates are just really high, and they're like, I'll just put my money into bonds or something that pays a high interest rate because it's all risk and reward. There's no risk. I can earn 6%, 7%, 5%. Why would I want to put in a risky investment? And then there's kind of like an order of things. The safe public entities like an Apple or an Nvidia, those are great starting points for when you're going to open up the cash. Then comes sort of the smaller public companies, and then you start looking internationally, and then you sort of say, okay, maybe there's everything is kind of getting scooped up and the valuations are getting higher. Where's the next opportunity? And you kind of investors start to work their way down the market. I'm talking about sophisticated investors, right? And so I think we are still at a stage where we're waiting for the wallets to open up for startups. Yes, some startups still do get funded, but it's not like it was before where just on a deck you can get money. And so that is going to come, but I think it won't come until we start to see interest rates decline. And so what I've been sort of really noticing in the market is you really got to work for that investment, and for that money. And people will put in less than what they usually put in. So you probably have to go to multiple sources. It's their market right now. It's the investors' market. All of those things, like we were saying earlier, hey, here's some things that they're working in.
Right.
I think we might have to accept it because we don't have any other options. We know we're going to get burned down the road.
So pref shares, sort of liquidation preferences, very much in favor of the investor of the moment.
Yeah, and they may also do it by way of debt, convertible debt. You might not be happy with what they convert at a future rate, and so it really comes down to how passionate are you about this.
So the exit, the ultimate goal, to grow the company, win for the investors, results in some sort of exit that could be M&A, selling to a strategic, or an IPO, but not hearing many IPOs. Are you starting to hear people thinking about it, lining up, preparing for IPO? Where do you see the market?
Not yet. I think we know that there's a bubble forming in the AI space. And so I think where there's excitement, some money can flow into that. So I won't be surprised if AI-based companies are sort of are starting to IPO. But otherwise, just going for IPO, it's hard to do because you could list, but you need liquidity. And so after you list on the and you go public, there need to be enough investors that know enough about the story that are willing to also risk their cash in this environment and invest. Whether you're public or not, you're still the same company. Yes, your shares are liquid, but you need investors. Otherwise, after you go public, if you have no liquidity, your shares just decline. You can't do anything as a public company, and I've been down that road before as well.
So shifting gears a little bit, You've been doing the fractional thing for quite some time. You've also done quite a bit of advisory work, board work. Talk to me about some of the advantages of being a contract CFO in terms of the value and the benefit to those businesses.
Yeah, like when I'm first starting off, what really sort of attracted me to fractional CFO is I love going into companies where it's almost like an 80-20 for me. I have such a huge learning curve, and still can add value from the experience that I have. And what happens over time is you end up seeing so many different models, and meeting so many different types of peoples and personalities and different entrepreneurial types and leader types and C levels. That the advantage of it really is you end up accumulating a lot of knowledge, and the benefit that you bring to the table is that knowledge, because you've seen it. Like I've seen every type of thing that's out there, one way or another. And I'm not saying I've seen it from a success perspective.
Yeah.
I actually learn more from the failures than I do the successes, because you're like,
what to avoid.
it just gets ingrained in your brain. You're like, I'm never going to let this happen again.
Yes. Yes.
And that's the fear comes into you right away. And then also when you succeed from that, because now I've been doing it long enough where like, I remember this, not going to happen. This is not going to happen. And then the company succeeds as a result of that. That experience shows in that process that I go through, that try before you buy. Let me spend 30 days. Let me answer your questions and then come up with a 90-day plan. The quality of those results comes from the experience. Mm-hmm. And that's where you end up having an advantage over someone that may have worked within one company for a very long time. I kind of remember my days as an auditor, where you used to go into multiple companies, you spend a few weeks there, meet everybody, find out the model, and move on to the next one. Maybe you didn't like the audit itself so much, and also the fact that we were hated by the company. But it was actually a lot of fun. You end up, when you come back the second year, it's not so bad, because they're like, "Oh, Harp, good to see you again," and the ability to sort of see so many different companies and people and stuff like that is what I loved about being an auditor, and I got to apply it now here. The other advantage as well is, like, I always negotiate some, like a rate and equity when I can as well. And so I've been with a company full time for 4.5 years. Had a good percentage of the company, and then the company went bust. And you spend 4.5 years, and you're like, I got nothing to show for this, right? As opposed to, I'll take little bits, smaller bits of more companies, a smaller piece of a whole bunch of pies, right? And understand and just play the numbers. If I know 1 in 10 is going to succeed, all right, I got to go get equity in 10 companies.
Yep.
And I don't know which one's going to work. You just don't know. But you're gonna be the one to help increase the odds. The long game ends up being, you end up knowing a lot of board members. You end up knowing a lot of entrepreneurs that have exited. A lot of other sort of C levels as well that you can call on when you're building out teams. And over time, you're like, gonna remember this person, gotta keep in touch with this person, gotta make sure I stay tight with David, because he's a good guy. By the time you get to this sort of stage, you have a whole sort of network that you can go to when a company needs specific help. And sometimes when I say, hey, you may not need me, you may not need a CFO. However, let me introduce you to some people. So you're still adding value, because those are the types of companies that come back to you.
Harp, man, you brought it. I really appreciate you doing this. I feel like we can probably spend hours on each of these topics, and so that's a good reason to have you back again if you're willing to. But thank you so much for doing this, and until next time, really appreciate it.